Okay, now in this video we're going to talk about the income statement. Now the first thing that you might notice is that it says income statement for year ending 31st December 2021. And if you can recall, when we were talking about the balance sheet, we had as of 31st December 2000 whatever, right? So that was at a point in time. Now here the distinction is that the income statement shows the company's financial performance during a given time period, right? So that could be quarterly or yearly in this case. Now that doesn't matter. The point is that the you can say the balance sheet was showing a snapshot of the assets, liabilities, and equity at a point in time. The income statement tells the story of how we got from that point to the next point, right? So it tells the story of what happened in between, right? So that's one point that I wanted to make before that. Now, when we were talking about the income statement, or sometimes it's called P&L, profits and loss statement as well, so different names, right? Now, the income statement, the essence of the income statement is about two things. It's about revenues or sales, you can call them, and expenses, right? Because, whatever revenue that your company is generating, you got to have some expenses in order to achieve those revenues, right? And when I'm talking about expenses, mostly we're talking about three different categories of expenses. The most important one is called operating expenses. You'll see what I mean when we go through the example. But we can say, generally, all the expenses that is related to, the whole operation part of the company, right? Then we have financing costs, right? Like loans, interest payments, all that. And then we have income taxes, the tax expense part of the whole operation, right? So now, in order for us to truly understand what I mean by this, let's create an income statement from scratch. And we're going to assume that let's say you're having a manufacturing business, right? So you manufacture something and then you sell them. Now, one more thing before we start our income statement is that the other thing was that on top of the statements, normally it is mentioned whether the numbers are in millions, billions, or thousands, right? Here we are also going to assume that we are working with millions, right? Okay. Now, so you're in a manufacturing business, you're manufacturing something, and then you're selling it. And let's say you have sold whatever you're selling, and your revenues or sales ending for year ending 31st December 2021 end up to be 650 million, right? Now, the point is that you can't just take this money and run, right? This money, the whole thing is not yours. You have definitely gone through some expenses, some costs until you got this revenue. Now, the first expense that we have to consider is what is called cost of sales. And this, you got to keep in mind that anything that is related directly to production. So when I'm talking about cost of sales, here we are talking about anything that is directly related to, let's say we're talking about the manufacturing business, anything that is directly related to manufacturing that product that you end up selling, right? So the raw materials, anything. So that's the cost of sales. And sometimes this is called COGS, cost of goods sold, right? So that end up to be, and we know in accounting we put parentheses when you're talking about negative, so that end up to be 450 million. Okay, so you have a 650 million of revenue, you have 450 million, which is the cost of your sales. You deduct this from your revenue, you're going to end up with something called gross profit. which is in our case 200 million. So that's your gross profit. Again, that's the number, this, a lot less than that 650 million that you end up getting as your revenue. But still, that's the number that you cannot, again, take it and run, right? You still have some other expenses, and we call them other operating expenses, right? By that I mean that you've definitely gone through some, let's call it marketing, right? You've paid some salaries, right? So all of these things are, and many other things that you have gone through. And the main ones are selling expenses, like I said, something like marketing, and you paid for compensation. And then you have general and administrative expenses. This is mostly your fixed costs. For example, you paid, salaries, you paid for the rents, everything else. So these are your general and administrative costs. These are the things that, regardless of how much you end up getting as your revenue, these are the things that you have to pay for anyway, right? And then we have something called depreciation expense. We have talked about depreciation and the whole concept of depreciation and amortization when we were talking about the balance sheet. So hopefully you're all familiar with that. Here we are calling it depreciation, and we can conclude that we are talking about a physical asset, right? A tangible asset, right? If it was amortization, that was a financial asset. Now, the point about this depreciation expense is that it is a non-cash expense, meaning that, yes, although we, bought a long-term asset, let's say an equipment, and then we decided to allocate something called depreciation expense and then expense that long-term asset over the useful life of that asset. But that's not like we are actually paying this amount. This is the amount that, in terms of the accounting standards that we have, we are, allocating that expense, and we are estimating that this is the amount that we are estimating that, after the useful life of that asset, we have to replace it. So we are expensing. But this is, what you have to keep in mind. It's a non-cash expense. So this is not actually coming out of our pocket. And the reason I'm really emphasizing on this, you will see it soon what I mean by that. So let's leave it at that here, then we will get to it, we'll talk about it. So we had some revenue, we had some costs associated to those revenue, we deducted that, we got to gross profit, then obviously we have some other operating expenses, marketing, sales, rental, utilities, all of that, and we had some depreciation expense as well. So we add these expenses up, we're going to get to the total other operating expenses of 90 million. So we have to deduct this 90 million from this gross profit as well, and we will get to a number called operating income. Remember this line. This is a very important line. So operating income, 110 million. So as you can see, from 650 we got to 110 million, which is our operating income. So far we have gone through the operating expenses, but still we got financing and taxes, right? So you probably have some loans, right? And you're paying some interest on that loan. So that is your interest expense. And we are assuming it to be 15 million here. So that also has to be deducted from your operating income. Okay, so let's do that. Your earning before taxes, after we deduct this from the operating income, will become 95 million. And as you can see here, we call this earning before taxes. So we have gone through this one as well, but we still have to deal with the taxes, right? You got to pay taxes. You can't, again, take this and run. You got to pay your taxes. So let's assume the income tax that you're paying is 90 million. Again, you deduct that from this. You will get to a number that is, everybody's looking for this number, which is called the net income, right? That's the number that you can take and go home, right? So as you can see, it's a way different number than your revenue. You had a 650 million of revenue, you end up with a net income. That means after you paid for your expenses, your operating, your financing, your income, this is the number that you end up with, right? So that is called your net income. Now, here, the operating income has also a specific name that you might hear, in different income statements, or you hear it on the news channels, they say it. So this is called the operating income. The other name for it is called EBIT. Right? EBIT. That means earning before income and tax, right? Now, the reason we are emphasizing this part a lot, that's because, if you want to judge the management of a company, this from, here onwards, these are the parts that, has the management has direct control over. From this point on, the interest and the taxes, the interest rates, could be different. It's not like the management doesn't have a control over it, but it has less control over it. So the interest expenses, in terms of the overall interest rate and the interest that the bank is charging, and in terms of the taxes, whatever the politicians comes up with. So these are, you don't have as much control over them as you have this much. So this part, the operating income, you gotta want to pay attention to, because that's the part that you can, judge the management for it. And still, if you want to have a better number than this one, that the EBIT, which is the operating income, I took my time here to explain this is a non-cash expense. So because this is not actually going out of the, company's pocket, right? So let's add this one to our operating income. So that will be EBIT plus depreciation, or if you have amortization, but here we don't have amortization. We're going to be, if you add this one to your operating income, the term will be EBITDA. This is pronounced EBITDA. And you might, again, hear this term a lot. EBITDA, because we have added the non-cash expense to our operating income. So this is actually a much better number if you want to judge the whole management team and the CEO and everybody involved in the operation. This is a much better number to judge the whole management based on. So we had 110. We had 110 of our operating income plus the 40. So the number that you can compare to the previous periods and everything to judge if the management is doing a good job or not, that would be the number, 150 million. Okay, just keep that in mind. Now, we also, most of the income statements, they have some additional information. And before that, let's make this one look nicer. So, additional information. These are your additional information that you are likely to see when you look for a company's income statement. The first line is called dividend paid to shareholders, right? Now, the whole story of the dividends and because, we have a equity section, which we will talk a lot more about all of these in the equity section of the course. But here I'm just going to briefly talk about them. So dividends, when a company makes money, then there are board of directors, and then they are the ones who decide whether to, distribute some of that income. In our case, this 76 million, to decide to distribute some of that income with the shareholders, right? To, distribute it amongst themselves. And this net income, also called sometimes earnings, right? This is something that you might hear a lot on the news, that, the earnings announcement, earnings, this and that. So that's what they mean, that they mean actually the net income. So the dividends paid to the shareholders is the amount that sometimes when the company makes money, the board of directors decide to distribute amongst the shareholders. And in our case, let's say they have decided to distribute 43 million out of that 76 million of it, right, to the shareholders. Now, if we actually deduct this dividend part from the net income or the earnings, let's do that. 43, you're going to be 33 million, right? Now, keep this 33 million in mind because, we had a line in our balance sheet called the accumulated retained earnings. And I'm going to bring it here so you can recall that part. So if you can recall, we had the assets, liabilities, owner's equity, and this is the owner's equity section of the balance sheet. We had common stock and we had accumulated retained earning. Remember, right? So in the accumulated retained earnings, actually here we had 2020 and then 2021. So year 2020, year 2021, December, right? So the accumulated retained earnings in year 2020, it was 115 million, right? That means from the beginning, from whenever the company started, up to that point, as of this 31st December 2020, they have accumulated retained earnings of 115 million, okay? Now, from 115, they went to 148 million. So it went up from 2020 to 2021. Now, where this difference came from. So let's do a simple calculation. So we started with 115. Let's add this much that we have calculated here, which is the difference between our earnings, net income, and the difference of the dividends that we have distributed. That 33 million. The number will be 148, and that's exactly the number that you see here, right? So the difference came actually from here, which is the amount that they decided to retain as their earnings, right? So they made 76 million, but out of that 76 million, they decided to distribute 43 million of it. So the remainder was 33 million. You add that to whatever they started with, which was 115. You add that, you got to get into 148. And, even if you do not have the income statement in front of you to come up with this number, you can easily find out what the retained earning was, from the previous year to this year. So that's obviously the difference between these two, right? 148 minus 115, that is your $33 million. That is the retained earnings that we added to the whole accumulation of retained earnings. Okay, now the other additional information that you see here, another important point is the number of shares outstanding. Again, these are mostly related to the equity section of the the course, which we have a section dedicated to it, and we will talk about this a whole lot. But here, let me just briefly say it. Number of shares outstanding, which in our case is 50 million. That means, that's the total number of shares that the company has issued, right? So that end up to be 50 million. Now, we have a line here called earnings per share, or it's famously called EPS. Again, you might hear this one a lot on the news channels and everybody else, that, the EPS went up, from this company. So the EPS, which stands for earning per share, and in our case is $1.52. But how did we get this number? Very easy. So we came up with the earnings of 76 million, right? So 76 million of earnings. You divide that by the total number of shares outstanding, which is 50 million. You're going to end up with 1.52, which is your EPS. Okay. Now the next line is dividend per share. In our case is 86 cents. Again, you have your total dividends paid, which is 43, divide by the total number of shares outstanding, 50 million. That will be 86 cents. Okay. And these numbers matter a lot to the investors because, you know, in case you are out of the whole 50 million shares, let's say you own, I don't know, let's say you own 1 million share of that. So you wanted to know what is the whole earnings in terms of per share. So that's the information that is normally provided on the income statement. And by the way, this dividend per share also, it is called DPS. So these are the abbreviation of these terms that you might see a lot on the income statements. Okay, so I think we have covered everything here. Now in the next video, we will talk about cash flow statements. See you in the next video.